Okay, July 28th, 2026. I wanted to give an update on TickerPulse, what's going on. I haven't been able to do the daily videos and everything, just a lot going on with the kid. She's 2.5 years old, and it's very hard to sometimes keep focus when your kid is going through this independence stage, as one would say. You know, they're asserting their independence and their ability to refuse things. It's not easy. But here's what we're working on. So we are going to, I don't know the proper technical word, but deprecate or put to rest, sunset the current TickerPulse app, the sentiment engine that analyzes YouTube videos to find the trends. And we will be launching a new reports engine that's more specific. I posted a Twitter about it, giving the details, that gives more specific signal market intelligence by the ticker itself. So before, the TickerPulse app that we have now has been collecting trends off of social media, like what stocks are the most talked about. But the problem is people only talk about the stocks they like and are only always saying you should buy, dollar cost average and keep buying. And no one's really giving, we couldn't get clear signals on when a sentiment would change. And there were some big misses, like especially with NVIDIA, right? Like to get clear sell. I posted that I sold out a majority of my NVIDIA at 220. I had enough of it, and it's a great stock, great company, but there's a lot of fog, on the earnings, right? Are the earnings really what they are, or is it all like a shell game? And I'll come back to that, but what I want to do is talk about the app, and then we'll talk about my thoughts on NVIDIA and SpaceX. So, so the new app, which is called Signal Forge, and that'll be the new name of the company, new name of the platform when we get there. I'm working on it with a friend of mine who's got a PhD in computer science. He was a nuclear engineer from the Navy. I met him in nuke school when I was in the Navy. I ended up going on becoming an intelligence officer, and he went down the nuclear engineer route, and then he later on got a graduate degree and a PhD in computer science. But he's always had an interest in finance. We were going to options seminars on how to trade options back in the 90s. And so he really understands the math. And what he did is he created a engine that more precisely analyzes the market signals, does like signals intelligence or signal processing. And we're going to be able to produce reports by each stock. So we'll be following a handful of popular stocks and then keep growing the coverage, instead of like trying to get put out a net and catch everything in the market, what's being talked about. We're gonna, because we already know that, I can watch 3 or 4 YouTubers and already understand what are the popular stocks, or the ones, there's like a Mr. Fired Up Wealth, there's Parkev, and then there's this Felix and Friends, the guy with the golden retriever, and then there's Schwab, on the mainstream media, if you watch Schwab Network, and then Peter Anderson, so these are my top 5 sources, and from there I can just on pencil and paper pretty much determine what are the most followed stocks or most trending stocks, and from there we will be able to develop a signals report using Jason's proprietary algorithm. And they've been pretty good. They give pretty good analysis of what's driving the stock price. Now I'm doing this all unscripted, and unedited. I just if I go down that route, then it becomes like a full-time job. And I'd like to get stuff out there as quick as possible. But yeah, so it'll give like clear, more I'd say granular is the word I'm looking for, more granular and actionable more granular and actionable insights into now it's not financial advice, of course, it's just what we think and what using our algorithm and our prompts arrived to this conclusion. And I'll have this out, this should be out in a week or two. Like I said, we're just starting out and learning as we're going, and as new information becomes available, we respond to it. Now, let's talk about NVIDIA. So why is NVIDIA down? Nothing is wrong with the company. It's still producing the earnings, but what people are concerned about is the circular flows. But I would argue, I did some reading in OpenAI. OpenAI is generating revenue. It's growing the revenues. I'm not completely sure about their profit picture, because it can be argued that maybe they're rolling everything back into growth, right? When you start a company, you take everything you make and you put it back in to grow. So they're using NVIDIA as a bank, essentially, as like the way kids use their parents to guarantee loans. And also I think they're getting some financing, but this could be equivalent to a car dealership. When you go buy a Ford, they can also give you the loan for the car. They don't just sell you the car, they give you the loan. Sears did this. Sears financed their purchases. So you go buy a washing machine from Sears, and you get the Sears credit card and you put it on the company card. So I think NVIDIA is becoming a bank. Now, Wall Street doesn't like this, especially when we're in an environment where rates are going to be trending up. Kevin Warsh had said that he wants to get the inflation down, which means rate hikes. So the knee-jerk reaction on Wall Street is this: suddenly NVIDIA goes from being a safe compounder like Berkshire Hathaway. It's just minting all this money, and they're just stacking cash, to suddenly financing what they feel is a risky project, a gigantic data center. Now, I want to go a little bit deeper into this data center. So this data center is somewhere in Ohio or the East Coast or something. I didn't get a chance to get the exact details, but the Japanese are building the power generation for it, and I think financing part of it as well. SoftBank, who's been interconnected with NVIDIA for a long time. And then they're also going to be backstopped by the U.S. government. And that's why I think if this AI bubble is real and it busts, the U.S. government's going to bail it out. They always do. You can just look at history. They bailed out Chrysler in the 80s. They're going to bail out. They bailed out the banks in 2008. They didn't do anything in 2001. They let that .com bubble. They let everything burn to the ground. I don't think anyone got rescued there. That was probably the only time they didn't do anything like that. I think this would get bailed out. And I have like a mixed view on this bubble. It's like I think we have a bubble in bubble talk, because the government, the people who want to control people, they need these data centers to control us. So they're going to stop at nothing to get them built, and that's what I feel like is going on. Now, yes, air pockets are forming. There's like always some bottleneck, like they can't get the land clearance, so then suddenly a bunch of GPUs could pile up because they're not ready to be deployed, and then they slow down the orders of GPUs, or they don't have the power or the water and all of this stuff. But when I was talking to my friend, he said that actually a lot of these H100s and everything, these used GPUs are still commanding a high price. There's still enough demand, I think, to reroute any orders or any over surpluses to another buyer. So this revolution is it's happening. And I think Jensen Huang, he had come on and said they can't build fast enough to meet the demand. And we're also seeing some evidence that the data centers are in demand. I mean, Anthropic rented some space from SpaceX, at $1 billion a month, and Google also wanted to rent some space because Google said they're going to be doing a build out, but if they can't meet the demand, and that's also what happened with Google. Google itself went from just a money printing machine, to now taking on risk that they want to build out do a massive build out, more than what was expected. So they went from stacking cash to like spending cash more than they make, from, having a surplus every month and now having to, borrow and maybe dilute the shares. And that's why people are fearful. The whole risk profile has changed. These companies that were just money printing machines and very safe and had a big cash buffer now are taking on risk to expand. But then at the same time, if Google doesn't do the expansion, it's just it's going to come crashing down anyway, because most of their stock price is based on future growth, and if they don't have future growth, then it's going to come down to an 8 PE and just be a dividend stock. It'll be like General Foods or something, and I think that's not what people want. So Wall Street, but this is just anyway how Wall Street reacts, right? When a company goes from like a cash printer to a cash burner, whatever the reason is, it's a good reason, right, to expand capacity, and they know they can sell it. We don't know, actually. I mean, it's like the railroads. They built a lot of railroads and then they went unused, everything crashed, and then it was bought on pennies on the dollar, and then it ended up coming later. It's like the .com. Everything went up, there was a whole bunch of overbuild, everything crashed, someone else bought it, like this Nortel Networks bought all that pennies on the dollar, and it ended up getting used anyway. So there are like air pockets, but this time it's like with it's not with speculative companies, it's with established companies. That's what's different. Like in the railroad, there were a lot of new companies, and they didn't have any revenues going in. So Google, if it didn't do AI, would have the search and everything, but it wouldn't have the growth. But according to when I talked about my friend, the demand is out there, but there's just things are a little bit like anything else. Like when you do a home renovation project, so the plumber needs an extra week to show up, and then your stuff is piling up outside that was supposed to get used, or the plumber shows up and the bathtub doesn't arrive, and it's just that kind of stuff, just associated with building something new. So where am I on this? And this is not financial advice. I'm just holding tight. I've already sold off a bunch of NVIDIA in 220 long back, and not even because of something against the company. It's just because it's so big. I mean, where else can it go? It was like at $5+ trillion market cap. I mean, every portfolio has it, even if it's the greatest company in terms of valuations and everything. Portfolio managers, professional money managers are limited by how much of any kind of stock they can have in their portfolio, no matter how great it is. So NVIDIA would just keep growing and would outgrow its allocation. Like it would maybe have a 10% allocation in some conservative portfolio. The portfolio manager has rules. He has to sell it off and keep it at 10%, if it keeps growing. And this is the problem with the mega cap companies, is that they're in all these portfolios, and it becomes like a asset allocation decision more than is it a good company or bad company. So there's these other factors, and a lot of these bloggers don't talk about it. They just talk, oh, it's a great company, chips. So it's out there, but there's like distortions forming in the market. There's that are creating these pullbacks and everything. Now, are they opportunities to get in? I can't advise on that. I mean, I have an allocation rule in my own portfolio, and I'm not buying any more NVIDIA or tech companies. I just have a covered put that will probably get executed by more DRAM ETF, because I also believe the memory story has also gone from cyclical to structural or steady, because they will be replacement cycles as well, that there'll be some better, just like when the computers were out in the 90s, every 6 months a better one would come out, and it was worth your money to throw away the old one and buy a new one because the processing power and features were so much better. It would pay for itself like in a couple months, so it was worth it. And this is what my friend had told me, that there will also be these replacement cycles, just because they'll be so compelling. The new chips are 1,000 times, 100 times faster than the old ones, use less heat, so they would pay for themselves if you replace the old ones with the new ones. The increased compute, reduced cost, it would pay for itself. It's just like, when you put insulation in your house or a new heating system, there's always this like, your current heating bill is $100 a month, and then if you put in a new system, it goes down to 20, and the new system is $800. So in 10 months, it would pay for itself. You know, you'd recover your capital costs, and then you would enjoy a lower running cost in the future. And then that extra $60 a month is profit in your pocket. This is the same kind of thing going on in the AI world right now. And yeah, they say it's at the very beginning. I always get skeptical of that, but the internet was at its very beginning when it crashed, the dot-com bubble. And all the great stuff, the Google IPO, Facebook, all that stuff happened long after the crash. And a lot of the other companies, Shopify and all this, came about long after so that's where you have to be a bit careful. But now the valuations, the valuation issue. So we're nowhere near 1990s valuations. And I don't think we're going to get too many successive rate hikes like we were in the 90s. The federal deficit is too high. Kevin Warsh, they're talking about, and I'll drop this in the comments, about having a new inflation metric, which will show a much lower rate of inflation. So they're going to be much more gentler about hiking, because the interest payments on the debt will be so high, the government will push back, but I don't know, the Fed is in like a really, I don't want to say too much here, because like they're in really a box, right? If they raise rates, they can really screw up the budget, U.S. federal budget. All the interest payments will skyrocket. If they keep rates low, it'll be very hard to sell bonds. And already the bond market has got its own ideas what the interest rate should be versus what the Fed rate is. There's nothing in the bond market. The 10-year is nowhere near 3.5%, 3.75. It's more like 4.6. And it's very sensitive to the oil prices now. 4.6, 4.7. So I don't know. What I'm doing at the end of the day, I'm just holding steady. I'll probably take this DRAM. If my put gets executed. I'm short SpaceX. Through puts. I have long-dated puts. For June next year, and I think also Christmas this year at 70s and 80, at $70 and $80. And I think they're going to hit. I think SpaceX doesn't have a prayer. I think once this unlock period happens, even the forced NASDAQ buying isn't going to save them. The sun is the wrong way here. Yeah, I just have to, maybe I'll go across to this park. So, let me cross the street here. I'm in Lviv, Ukraine. I live both in Virginia Beach and Lviv. I know Felix and friends. He's always in Asia and in the south of France. But my stomping grounds is Virginia Beach and Lviv. I got my daughter in daycare here. It's really good. Daycare in Ukraine is like something really spectacular. It's the best kept secret. But that's so the SpaceX. But like I said, this is just what I'm doing. This is not financial advice. Do your own homework. It's a capital intensive business. They're not printing records. They're not selling the SaaS solution. They need real estate. They need metal. They need expensive people, expensive employees. Environmental regulations, all of it, right? And a company's value, like that. I mean, at worst would be 40 times profit. What their profits are. They haven't got any profits yet. Only Starlink is the most profitable unit, and I don't think that's worth trillions of dollars. There's already internet on airplane providers and this kind of thing, but as I said, that's just my view. I think there's an opportunity to catch this whole unlock wave. To me, it's very clear as all these shares unlock, it's going to flood the market. And a lot of these bros, these Tesla bros who got IPO shares, they're pretty upset. They dumped. And by the way, I dumped my last Tesla shares like 2 minutes into the call when Elon started talking. You know, to me, he sounded like he was drunk or on drugs, or he didn't even want to be there. And he didn't really have anything to say, but as soon as he opened his mouth, I hit the sell, and it was just before it broke under $400 or $398. I think I got out of there just a hair under 400. And I had sold my Tesla lottery. I call it like keep a lottery position, because you never know if they figure out the full self-driving. That's the panacea of AI, right? Autonomous driving. You'll need a ton of data center for that. You know, you'll need a ton of processing power, and that will change the world more so than even the personal computer. Once you don't have to, you know, drive a horse or drive a car, and you just sit in a lounge and it takes you from point A to point B, and no human is involved, and it's cheap, it'll change the world. So I had that lottery allocation, but I'm out. I don't think Elon is, you know, he's involved with SpaceX when he needs to be involved with the true FSD, the kind of FSD that can go anywhere on any road, you know, and not run over a kid, not in a geo-fenced area, not with a minder, not with human intervention. And it's still far off from that when you do the deep dive. All of it, Waymo, they're all far off. They're just working they're just basically on rails, you know, in very carefully curated zones. So you should be able to just drop off a Tesla, a robo-taxi in any city, and it can plug into a mapping software and not run over a kid, you know. So yeah, so that's my view there, you know. So I you know, like I said, as soon as he started talking, I had enough, you know. And like I said, SpaceX was just, I think, to me, we were, you know, the people, the bros, the Tesla bros were the exit. I didn't, I had ordered shares on Schwab, you know, then I decided to cancel. And the more I read the S1, the more hokey it just seemed to me. And then when he started talking at JP Morgan, you know, that just really disappointed me that Jamie Dimon was embellishing this guy's fantasies. And if you want to, if you want some historical reference on Elon Musk, read about Howard Hughes. You know, Howard Hughes was one of these really smart guys doing all this breakthrough stuff with aviation, movies. He was into everything. And then, you know, he went crazy. He moved into a Las Vegas hotel room. I think he owned the hotel there, and grew his fingernails really long, and had this paranoia about food, that he would only have like wrapped or sealed food, like eating baby food or something. And, you know, so yeah, I mean, it's not the first time this sort of thing has happened, you know. So, you know, I think we've reached peak Elon, and I would be willing to bet, you know, more that he's going to end up in a hotel room, probably with a Mars decor, so that he would think he's in Mars, and grow his fingernails long, than, you know, getting us FSD or Hyperloop. There are so many broken promises. You know, we were supposed to have Hyperloops that could connect the East Coast. You know, we need this stuff on Earth first to get solved, full self-driving and Hyperloop, before we start going out and doing crazy stuff in space. But I've always been personally against the space program. You know, it's biblical. We're not supposed to be there. I think only the military should be in space. Let's see, we gotta wait for the light to change. You know, it looks like, yeah, we can go. Yeah, so, yeah, I just, that's my own view though. You gotta have a view. When you're investing, you gotta have a view. You know, that's very important, to have a view and have a conviction, and invest by your convictions and views, while keeping an eye on valuations, because valuations do matter. You know, when things start going parabolic and the PE ratios and things don't make sense, I mean, you can get away with that when you have tailwinds, like low interest rates, you know, and no war in the economy, and a lot of positivity in the news flow. But, you know, when you start getting a war going on, and, you know, they talk about rate hikes, then you don't have you have headwinds, and then the ratios matter more, and the things start people are looking for an excuse to sell off, whereas you know, when you have tailwinds, people are looking for an excuse to buy. So it's very important to know which way the wind is blowing. But anyway, that's all I got. If you've gotten this far, thanks for hanging out. Like and subscribe. A lot of new things are coming. Bye-bye.